Good morning, and on behalf of Barclays, I'd like to welcome you to the Private Bank South Africa webinar, the second in our series on global family businesses in South Africa, investment, structures, and sector trends. My name is Amol Prabhu. I'm the country CEO for South Africa and market head for the Africa Private Bank franchise. I'll be shortly handing over to David Bell, the founder of the PCD Club. But before I do, I'd like to just say a few words about Barclays in Africa. As a franchise, many of you will be aware that we've been on the continent operating for over a century. And while certainly our business model has adapted and changed over time, our commitment to the continent and our commitment to clients certainly remains. We've established an office here in Johannesburg, where I'm based, and we have an experienced team of South Africa-focused private bankers, as well as a very deep bench of staff globally that have Africa experience. The majority for over a decade, many have lived on the continent or are from the continent. Our African model is really centered around three businesses: private banking, investment banking, and corporate banking. The focus, of course, of today's session is private banking, supporting global families, ultra-high and high net worth individuals, and of course, family offices. And we have a specific family office team within the private bank, run by our global head, Effie Datson, who is one of the speakers today. And today promises to be an extremely informative session, covering topics such as family office trends, including establishment and best practices, as well as recent research on wealth transfer, be it estate planning or family business succession. As a private bank, we also provide support across a number of other areas: financial portfolio diversification, strategic investments, UK real estate being extremely popular, and philanthropy. Now, I understand the audience for this webinar are mostly financial service providers, lawyers, auditors, trustees, etc. And so I'm very keen for Barclays to be connecting with you and working with all of you for our mutual benefit and, of course, for that of our clients. I'd encourage you all to think of Barclays where your clients have complex and multi-jurisdictional needs, where your clients really require an independent, stable financial partner that has an extremely strong links across the corridor: South Africa, Africa, and into the UK. The UK, of course, being our home market. And where your client's journey may evolve and develop over time, moving away not just from private banking needs, but also into the corporate or investment banking space. So please do feel free to contact me should you have any further questions about our Africa franchise or particularly our South Africa franchise. And I will now like to hand over to the moderator for today's session, David Bell. David.
Well, thank you, Amol, for that welcome and introduction to this session. Looking forward to the next 60 minutes where we're going to discuss the latest trends from family business and family office structuring, investment, and all the latest trends from linked to South Africa. This is the second part of a two-part mini-series we're doing with Barclays Private Bank. The first session on global wealth planning was extremely well received. We've got three expert speakers who are going to introduce shortly. Amol is also going to join us for some questions, and we're really looking forward to hearing from you your thoughts and comments as we move through these sessions. As always with PCD Club, we have a very broad international audience. We love to hear from all of our participants who are dialed in for this call. Please do put some interesting comments and questions in the chat, and we'll bring them direct to our panel as we move through. We are going to speak to across the course of the next hour, we're going to speak to a number of different experts. One of them, Quintin Mullet-Marquise, is from the investment banking side of Barclays, and he is the head of FIG for Middle East and Africa based in Dubai. He is going to focus on some of the investment opportunities that he sees for high net worth clients, family office investors, particularly looking at the financial services and fintech sector. So we're going to hear from Quintin shortly. We're also going to hear from Johan Odendal, who's the managing director of Corpag in South Africa. He's going to talk about tax and legal structuring and how family businesses are managing their affairs overseas We're also going to talk about the loop provisions, which are interesting provisions that bring offshore investment back into South Africa. And finally, we're going to talk to Effie Datson, who is the Global Head of Family Office of Barclays Private Bank in London. Effie is going to bring us the global perspective as to what family offices are doing. She's going to highlight some trends from some recent research on wealth transfer, on succession planning, also sustainable investing and impact. So really looking forward to speaking with each of those guests shortly. But before that, the global macroeconomic picture is vital for any family or family business operating on the international stage. Last week, I was fortunate enough to record a discussion with Henk, who's the Director of Investment Strategy for Barclays Private Bank in London, on the macro view. Henk gave a sense of all of the important considerations to look at, and here's Henk now.
Well, hello there. It's certainly a pleasure to be with you. I've been given a few minutes to set the economic backdrop and talk a little bit about the challenges that investors may face in financial markets as we look towards 2022. So I thought we'd spend the time looking at the progress that's been made in terms of the global economy over the course of the past year, pick up on a topic that's been grabbing the headlines and moving the markets, which of course is the threat of inflation, then think about how investors should be positioned as we look through towards next year and beyond. The reassuring news is the speed and the magnitude of the economic recovery during the course of this year has been far greater than anticipated. We know the recovery has been robust, but we also acknowledge that it's been turbulent and it's been uneven. But the improving medical outlook, the relaxation of restrictions, the overwhelming policy support, along with the strength of the consumer, has led to a robust recovery, as I say, for the global economy during the course of this year. So we think global growth will come in somewhere around about 6.1% for 2021. Now, that's a significant upgrade to our projection back at the start of the year, where we're forecasting growth of somewhere around about 4.7%, and actually above 6% would represent the fastest post-recession growth rate that we've seen in more than 8 decades. And the good news is the recovery phase, I think, continues to play out during the course of next year. We're still talking about above trend growth, somewhere around about 4.5%. What we do know is, of course, investors become increasingly concerned around the threat of inflation. I think they've got 3 major questions. Number one, are these inflationary pressures persistent? Number 2, will it lead to an early liftoff in terms of policy? And number 3, should investors adapt their portfolios, try and mitigate some of those risks? Given the broad range of demand pull and cost push inflationary pressures, perhaps no real surprise that inflationary prints have come in at elevated levels over the course of the summer months. You know, those relaxation of restrictions led to an unleashing of pent-up demand. Plenty of examples, as we know, around supply chain disruption. You see it in terms of semiconductors, in terms of container shipping, along with the labor market as well, that's certainly been pushing up wage inflation. When you add to that, of course, ultra accommodative monetary policy and that flood of fiscal support, along with statistical and technical factors and surging commodity prices, perhaps no surprise that those inflation prints have become quite elevated. But we do think some of those pressures will ease as we look towards the second half of next year. Some of those factors will indeed, I think, prove to be transitory. If you look at the level of spare capacity in many economies, still remains elevated compared to where we were before the start of the recession. Relaxation of restrictions should ease some of those supply constraints and allow volumes to increase once again. The real one to watch out for is going to be around wage inflation, because we know that's far more sticky than other types of inflation. The unwinding of furlough schemes, the easing back of those extra unemployment benefits that were put in place during the course of the pandemic, the improving medical outlook, and schools reopening should allow the inactive populations to turn back to the workforce and ease some of those pressures. We should also remember the recovery that we have been seeing during the course of this year has very much been focused on goods. We'd expect that to rebalance itself to focus on services as we look through the course of 2022. And think about the structural changes that have been taking place, the aggressive investment in terms of technology, the digitalization of economies that certainly accelerated during the course of the pandemic, and that should keep price pressures muted. What we do know is inflation has been higher for longer than anticipated. Central banks have been reacting to that. So as we've already heard from the Federal Reserve, I think we'll hear from other central banks about the tapering of those asset purchase programs. And I think interest rate hikes will come earlier than anticipated. What we don't expect is central bankers to embark on an extended, overly aggressive rate hiking cycle over the course of the next couple of years. In fact, we'd expect rates to settle below the historic average and even below what is considered a neutral level. Now, that's not to say, of course, investors can dismiss the threat of inflation. We know even a small increase in inflation expectations can do meaningful damage to wealth preservation assumptions. We know investors do indeed need to generate a return that's equal to or preferably higher than the rate of inflation. The good news is there's plenty of solutions that can deal with that, whether it's precious metals, whether it's within fixed income, or indeed our favorite, which is equity markets, but a specific part of equity markets, which is around focusing on companies that have pricing power, such as the luxury goods sector. So certainly something to watch out for as we go through the course of 2022. Listen, I think it's a nervous time for investors at the moment. They're worried about the peak growth rates that we've seen in terms of the recovery phase from the US and from China. They're concerned, as we've been talking about, the normalization of policy. Valuations, of course, are a concern when it comes to equity markets. You only have to look at the S&P 500, which is trading on about a 30% premium to its 20-year average. And we don't know about the path of the pandemic and exactly how that's going to play out. But as I said, the outlook for the global economy still remains strong. Central banks will keep rates relatively accommodative, certainly by historic standards, over the course of the next few years. The reassuring news is that companies are doing very well indeed. We're in the heart of the third quarter reporting season. Companies come into markets and tell us how well they've done over the previous 3 months, but also giving their guidance for the future. We've seen consensus beating numbers over the course of the past few weeks, and analysts still expect earnings per share growth for European and US companies to be above 9% as we look through the course of next year. So how should we be positioning ourselves? Well, being and staying invested, I think, is incredibly important. What we do know is holding an outsized cash position, which many of our clients do, comes at a cost in terms of the threat of inflation, but also foregone returns. We also think that active rather than passive investment is going to be far more important in 2022. A lot of the easy gains in the aftermath of the pandemic, we think, have already been made. Expect a greater dispersion in terms of performance as we look through the course of next year. Winners and losers, I think, will be identified quite clearly. Now, the markets are a great debate around whether it's growth or whether it's value. We don't get involved in that debate. We very much focus on quality. What does quality mean? It means conservative capital structures, fortress balance sheets, cash generating businesses, but it goes beyond that. Look for businesses that can generate cash, reinvest that money back into the business and generate the same level of return. But we also think diversification can be incredibly important as we look through the course of next year. That's diversification across asset classes and within asset classes. Fixed income is going to be very difficult, we think, next year. So the focus on having a partner that can deliver you assets in terms of the private market space, I think is going to be incredibly important for boosting some of those returns. I think if you stick to those principles, you're likely to be able to navigate what is set to be somewhat of a difficult 2022. And with that, let me hand you back to the moderator.
Well, a very interesting global macro view there from Henk Potts. And now just to focus in on a specific sector of financial services and Fintech particularly in a Pan-African context, but also linked to South Africa. I'd like to welcome Quintin to just give us an overview of opportunities that he sees in the context here in the financial services sector. Quintin.
Thank you very much, David, for this introduction, and hello, everyone. So as you mentioned today, I'd like to share perspectives on what's becoming a more topical subject, the rise of fintech across the African continent, the structural drivers behind this trend, and how Africa-focused family offices can be at the forefront of the space and benefit from the continued development of that industry. The African market has long been identified as potentially attractive for financial services companies. It's a predominantly young and largely unbanked population in markets with high growth potential. Of the 1.1 billion people in sub-Saharan Africa, 2/3 are unbanked. Only a fraction of those customers with a bank account have access to credit, and insurance penetration is on average less than 10%. However, for a variety of reasons, international strategics and banks in particular have found it very hard to come up with the right business model and risk-reward trade-off, especially following the 2008 financial crisis, which brought about more punitive capital treatment for overseas activities, higher compliance, AML, KYC, regulatory requirements, and more generally, a refocus on a small number of core domestic markets. This has meant that the development of the financial services industry has largely been left to local incumbents, some of which burdened by legacy technology and systems not adapted to serve today's customer needs in the most efficient manner, and without the financial capacity to make necessary investments to stay relevant. So as a result, fintechs and new ventures who are able to build efficient, fit-for-purpose platforms have had the opportunity to enter this large addressable market without facing much resistance and competition from incumbents. In fact, Africa is the perfect testing ground for technology solutions in financial services. Technology is key for customer identification in countries without ID cards or digital ID schemes, and in reaching customers in physically dispersed countries with poor infrastructure, who until then were actually excluded from the financial services sector. African fintechs have been building new bottom-of-pyramid solutions before rolling them out at low cost in other neighboring markets. If you add to this the growing number of well-trained, low-cost software engineers, widespread adoption of technology amongst the population, and less cumbersome data protection laws, Africa offers a very attractive environment for fintech development and adoption. What's been achieved by a number of local firms in the past years has been truly impressive. In 2020, there were close to 600 active fintech startups on the continent, of which 2/3 in South Africa, Nigeria, and Kenya alone, compared to about 300 in 2015. So that's a 2 times increase, despite the slowdown that was observed during the pandemic. And I'm sure our audience will have noticed that not a month goes by without a multi-million-dollar, if not billion-dollar valuation being achieved by an African fintech. To name a few, Kuda, for example, the Nigerian digital bank, raised $55 million out of $500 million valuation in August. That's only 9 months after raising their first $10 million in seed funding, which was the biggest seed round ever in Africa. This valuation of $500 million makes Kuda virtually the 6th largest Nigerian bank by valuation, less than a year after its inception. And with the aim of the founders of providing an alternative to the 1.1 billion Africans, you can easily see a path for Kuda to become a unicorn in the next round. And it's not only companies who are attracting capital in Africa to invest in fintech. DPI, Development Partners International, a London-based Africa-focused investment institution, a month ago raised a $900 million fund to invest in Africa-based innovation-led companies, exceeding their $800 million target and highlighting the growing investor appetite in the space. And whilst in Europe and the US, there are plenty of startups revolutionizing the financial services industry, what's truly unique about African fintechs is the impact and positive change that they entail. Making finance available on a large scale, on commercial terms, to the bottom of the pyramid is not only a compelling financial proposition, it also brings about positive change and has the potential to lift vast parts of the population out of poverty. And whilst this is not a novel concept, technology really has made these business models viable and therefore is the key enabler behind the large sums of capital that we see being allocated to the space by people who historically were absent, notably international venture capital funds, and an area where investors can make impact investment or profit with a purpose, a theme that's becoming more and more front of mind, especially with the new generation, and is where Africa provides, in my view, a truly differentiated angle in fintech. However, there still are some hurdles to overcome. And whilst I'm I'm overall very confident on the outlook for the African fintech sector, the reality is that some pools of capital still shy away from the space, owing to political, macro, FX volatility, lack of infrastructure, exchange controls, less developed equity markets for potential exits, and generally a lack of understanding or risk appetite. So in summary, there are several structural factors that, in my view, will continue to support the growing interest for African fintechs and high valuations that we've seen recently. A large and underpenetrated market in growing economies with supportive competitive dynamics and an ability to bring about positive change. All of this is made possible by the technological advances of recent years, and I will not emphasize this enough. Now, if I turn to Africa family offices and high net worth individuals, they have the opportunity to be at the forefront of this trend owing to their privileged position. As entrepreneurs and successful business-oriented families, knowledgeable about the African market, with experience of doing business in Africa and with local access, they can act as trusted partners to early-stage management teams. As stakeholders with a genuine vested interest in the successful development of the continent, and notably with the new generation keen to invest in disruptive technology with more and more of an ESG angle, family offices can act as the natural bridge between local startups and international capital, with the unique potential to generate outsized returns along the way and to have a positive, long-lasting impact. I hope you found this quick introduction informative, and with that, I'll hand you back to David.
Thank you very much, Quinton. We will take some questions after we've spoken to each of our speakers, so please do put your questions, comments, thoughts in the chat, and we'll bring them direct to Quinton and other panelists as we move through. So thank you for that. I'm going to come on now to Johan Odendahl from Corpbank. Johan, welcome.
Good morning, David. Thanks.
So you're a tax and legal specialist based down in Cape Town. We're just going to have a chat, I suppose, around the structuring opportunities for families trading overseas, successful family businesses from South Africa. Just to open up, I mean, what do you see as the kind of key trends for South African families seeking to operate overseas and taking successful products internationally?
Thanks, David. Yeah, so families with successful local businesses in South Africa continue to become more and more aware of the local risks in South Africa, and therefore continue to look to diversify interests and also to diversify the markets that they operate in and where they sell their products. Generally speaking, they look to plan for the future for their families as well as their businesses, and also to ensure that the next generations of the family can continue to remain globally mobile and that the business can continue to grow and flourish irrespective of what happens local in South Africa. So hence what we're basically seeing is a lot of South African family businesses are looking to expand their businesses, looking to capitalize on the commercial opportunities that lie outside of South Africa, whether that be in the rest of Africa or in other parts of the world. And as I say, this is done to hedge a lot of the risk that currently exists in South Africa for the business. And several of these businesses have done it very successfully. We've worked with a number of family businesses in the last 18 months that have expanded beyond the borders of South Africa, and at this stage all seems to be going very well.
Great. I mean, we heard from Quinton about fintech. I mean, do you see technology and innovation as something that's a key export? It's not always a product, is it? It might be IP, it's something developed locally but that can be sold cross-border. Is that a feature that you see as exciting part of the economy locally?
Yeah, absolutely. I mean, in particular in a city like Cape Town, which is known as the Silicon Cape, so Africa's version of San Francisco. We've got a number of very successful technology startup companies that originated in Cape Town, but offer offer a product or a service that is super useful across many geographies globally. So as you say, I mean, for a company like that, intellectual property is obviously of the utmost importance, and along with that goes the efficient structuring of that intellectual property. So definitely a trend that we're also noticing.
Okay, thanks. And what's a typical setup of a South African company that's starting to go overseas? Are there some typical features of a structure?
It always depends on a number of factors. Obviously, the location of the potential future business and potential future clientele plays a big role. And then also, because this is a family planning exercise, it's also very much dependent on the preference as to where the family would want to have their alternative base or their plan B, so to speak. So I always advise clients to take a phased and a gradual approach. There are many quality service providers out there that can assist family businesses to gradually enter a specific market that they would want to. Typically, family businesses use multi-layered corporate structures, which would consist of one or a number of operational underlying subsidiaries, and those subsidiaries would generally then be owned by an offshore family trust, and the offshore trustee would then be mandated to manage those assets for the future benefit of the family members, and also, very importantly, to ensure a smooth transition to future generations.
Okay, thanks. Question in the chat from Yudashir for you, Johan, which just asks on jurisdictions. So are there any jurisdictions that are preferable for structuring private trust vehicles to house interest in certain assets? Does that differ in terms of corporate and fund jurisdictions? So perhaps give us a sense of which jurisdictions most commonly come up for you.
Yeah, very good question. In my 10 years of experience in the industry, the trends have definitely started to shift from your traditional offshore jurisdictions to more, let's call them mid-shore or onshore jurisdictions where you would get a lot more substantive businesses. So at Corpag, we've seen a number of clients, for instance, that have pre-existing Mauritian structures that are now looking for an alternative to Mauritius, for instance. So we've been working with clients setting up structures in jurisdictions like Singapore, the Netherlands, the United Kingdom, and even Hong Kong, despite all of the politics going on in the East. But by far the most popular trend that I've seen recently is structuring to the USA. There's a big interest for South African businesses to expand their markets to the USA.
Okay, very interesting. And we wanted to also reflect in this conversation, it's not all outbound. There's some interesting areas of reinvestment into South Africa linked to offshore, and perhaps they'd be well known to the local advisors, but it'd be interesting for others to hear about the loop structures and how you see those being used.
Yeah, I mean, a very positive development at the start of 2021. After a lot of promise, eventually the prohibition on so-called loop structures were abolished by the Reserve Bank of South Africa. Basically, what that means is South African residents are no longer prohibited from owning assets in South Africa through offshore structures. What this means for family businesses, for instance, is whereas in the past, South African family businesses with local and international business interest would have had basically duplicate or mirror structures. So the same structure to hold the South African assets locally would be duplicated abroad for international assets. All of that can now be consolidated into one asset holding structure, which can be outside of the borders of South Africa, and that is very much seen in the industry as obviously a move in the right direction, and a move that will attract a lot of investment.
Well, it's interesting, the combination of those provisions with, as you say, dynamism and innovation locally, so people can invest in those tech businesses, or they can try and support the next new venture. Those two things coming together sound very exciting. But thank you very much for that, Johan. We will come back to you. Any questions for Johan on tax, legal, structuring? Please put them in the chat and we'll bring him back on to answer them. But I'd love to come now to Effie Datson, Global Head of Family Office, Barclays Private Bank in London. Morning, Effie. Good
morning, David. Very nice to be here and to see everyone from the PCD Club.
Great. So first of all, Effie, just wanted to get your response to Quintin's view around family offices getting involved in investment opportunities, particularly in the fintech space, financial services in Africa. Yep. What do you see of that as an opportunity?
Yes, I think Quintin really hit the nail on the head, that fintech is absolutely a dynamic and exploding sector. We see a lot of focus on it. At Barclays, we have an innovation lab, an accelerator lab that has been established since 1997 called RISE, in which we incubate fintechs. It has a physical space in London and New York. And so we actually see literally hundreds of fintechs every year coming through our doors. And we've seen some fabulous fintechs coming from the African continent as well, exactly around the point that Quintin raised around the underbanked population. Which have been so successful. They're multi-hundred million valuations, as he rightly points out, and that they're also bringing their products and services to underbanked populations in the developed market, in South Asia, in the Asian subcontinent, and kind of globally. So really, it's from Africa to the world, and a lot of that is driven by private capital. We see family offices very much looking at private direct investments, not just in fintech, but in a whole evolution of renewable energy and sustainable kind of businesses, to more technology-led innovations in life sciences, fintechs for sure, and lots of other subsectors of interest. So that direct investment in the companies of the future is a huge driver of returns for families, and it's particularly of interest to the next generation of family office family members, I should say.
Well, interesting that he thought the family offices locally in South Africa could form a bridge, guide, show the local knowledge, and perhaps take risks that to get the companies to that point where they can take on more institutional investment. I think an interesting gap there, isn't it? I don't know if you see that in other parts of the world within the family office space too.
Yeah, well, there's some really interesting trends that we do see with risk-taking between generations in the family offices. So definitely millennials, Gen Z are much more risk-oriented. We did a study looking at this topic, among other things, when we looked at the succession of, transfer of wealth between the generations. And we found that millennials had a sort of 38%, where 38% of them were focused on gaining more wealth for the family, versus the early boomer generations, only 11% were really interested in wealth growth. They were more interested in preservation and maintaining the family business across generations. But of course, as you know, our world is changing very rapidly, and sometimes maintaining the family business across generations really means reinventing it. And so you have to continually embrace new changes, new technologies that are coming. And so in a way, these things are not incompatible goals, but you need to work with the different generations and the different controlling interests in the family to make sure that older generations, for example, are comfortable trying out some of these new business models and bringing new technologies into the business. So that is a really core challenge of what I see happening, not just in Africa, but really globally.
Well, and also globally with family businesses around the world, the question of when to transfer, the interest in the family business, or the dynamics to bring through the next generation is a whole topic, isn't it? But I mean, what do you observe from that space of working with clients that might be of interest to advisors in South Africa as to when they look at these transfer points?
Well, absolutely. So just to put some context around this problem, there's 15 trillion of wealth being transferred between generations over the course of this decade, between basically now to 2030. And that is basically the size of the GDP of China It is the single largest wealth transfer in history. And about half of that is occurring with families who have a net worth of 100 million or above. So just to give you a sense of what is going on here, this is really a seismic shift in how families are, who in the family is owning and controlling the wealth of the family. And there's a lot of complexity to this, because on the one hand, you have the family business that might need to transfer over to the next generation, and then finding, who is the right person in the next generation, or people in the next generation to take that over can be very complicated. Sometimes we find it skips a generation and goes from grandparents to grandchildren, because the middle generation, it's not an interest of theirs. And then there's also the family wealth in the sense of the portfolio of holdings, of the financial holdings that they have, which might be independent of the family operating business. And so there's two components to this. A big element that we focused on was intergenerational trust. And I don't mean, the trusts and estates trust, but the confidence that the one generation has that the next generation will make the right decisions. And we found that there was actually 57% of wealth originators were kind of, were concerned about the next generation's ability to manage the family business. And even though the next generation felt like they would be taking it over, almost 90% believed that they would take over the family business. Only about 45% felt prepared to do so. So preparing the next generation to take over the operating family business is actually really important, and not something which can be done in a short period of time. You need to plan, you need to train that generation, you need to give them exposure to different parts of the business and allow them to run it, make mistakes, try to, fix things and get up and get going again. One of the things that we found really powerful as a result of all of this work we did around how families transition their wealth between generations is a really vital document is having a family charter. And I'm sure many of you in the room are probably having this conversation with your family office clients, but a family charter really lays out what is the purpose of our family, how do we want to govern our interests, how do we make decisions, what are the key principles and values that we will uphold, not just for one generation, but for multiple generations to come? What is the legacy we want to leave? So these are really, really important questions. And interestingly enough, more and more the answers are coming around themes of sustainability, ESG, impact, and so on. It's really fascinating trend to watch.
So having that governance debate about what does the family stand for then has to flow through into how they manage the wealth that they have, the business they operate, how they run a portfolio. You can't have inconsistencies there, can you, when you do that kind of exercise? So perhaps give us some views on sustainable investing as a trend that now gets so much airplay and more traction and buy-in from the clients that are looking for these solutions.
Yes, absolutely. Well, we're living and breathing sustainability these weeks in England with COP26 taking place in Scotland. So it's very much on the forefront of our mind, not that it isn't globally for many other good reasons. So we've just concluded a survey of 300 plus family offices with net worth of about $1 billion on average. And one of the clear and really startling trends was just how much more focus there is on sustainability. To give you some idea, in 2019, about 20% of the portfolios that these clients had were in sustainable and impact investing. And they expected that to grow to 22% by the end of 2020. So 2% growth year on year. What actually happened was it went to 36%. And they are now telling us over the next 5 years that 54% of their portfolio will be in sustainable and impact-oriented investments. So that is the investment portfolio. It's a startling growth rate, just to say nothing of anything else. But the returns are also really interesting because 80% of clients told us that that piece of their portfolio met or exceeded their investment returns. And 70% said that transition to net zero is the greatest commercial opportunity of our age. Okay, even the people who don't invest in sustainability or impact had no investment in that space. Even they, now a majority, 52%, have begun to incorporate ESG factors into how they look at their investing process. So it's really interesting, the seismic change that's happening in that space. This is going from, let's say an interest which was maybe a bit more fringe, maybe a bit more philanthropically oriented, to really moving to the core of people's investment portfolio, to their investment decision making. Their CIOs are having these discussions with them every day, and we, as a bank, are coming up with idea after idea after idea and company after company to show that it really is a phenomenal way to invest, just even commercially.
Okay, fantastic. Well, thank you for that, Effie. I'm going to bring all the panelists in now. And Sophie, perhaps you could flip us to gallery mode, and we'll just have a discussion, bringing in everyone. But first, we've got a good question in the Q&A that I want to bring to Johan. Just to actually from Dean Douglas, Johan, just saying about interesting points around the fintech space and associated IP. And in terms of the tax and legal structuring, I imagine there's a lot of complexity there as to how IP is being externalized, because Dean notes that traditionally exchange controls have a bearing on it. So I don't know whether you've seen this firsthand or whether you have observations as to expanding fintechs going overseas. What do they consider around the structuring of that internationally?
Yeah, very good question. Thanks for that, Dean. I think all of us, all of the tax and legal experts in South Africa know how complicated intellectual property is. I'm not going to stick my head out too far because I'm not an intellectual property expert per se. What I can say though is that from experience, it requires a very practical approach from clients because of the fact that intellectual property and the development thereof is a continuous process. What clients have been successful with in the past is to kind of draw a line in the sand or draw a distinction between pre-existing intellectual property and intellectual property that has developed post the setup of their offshore structure. But in those instances, we always advise clients to work closely with IP and exchange control specialists.
And as usual, substance is also very, in any structuring, substance is important, but I imagine that's also important here in terms of how development, how many people you've got on the ground doing things around the world is also a key thing, isn't it?
Absolutely, yeah. The substance requirement keeps on getting more and more important, Dave.
Terrific. Amol, just to bring you in, I mean, we've heard a lot there from different panelists. Did you have any observations to kick us off? I've got a couple of questions up my sleeve for you, but did you have any thoughts before we start that?
Look, I think the only thoughts really I have is, I mean, it's a super exciting time for Africa. I mean, it's a super exciting time across multiple businesses, multiple types of clients, coming out of different countries. And, I don't want to say what I said in the introduction, but, we as a firm are extremely excited by these types of opportunities and being able to help. And it could be on the investment banking side through Quintin, or very much in the global family office space through Effie and her wider team. And particularly in the family office space, we've been seeing even recently a lot of interactions, questions, around exactly the themes and ideas and thoughts that Effie was mentioning. And it's great to be able to feel that the firm is making a meaningful difference to many of these families as they go through their own planning. And it gets interesting because you're talking sometimes to 3 generations. It's grandmother, grandfather, mum and dad, and then the kids, and everyone's got their own opinion and frankly often slightly different views, which gets quite spicy sometimes. But yes. but it's super interesting area, and we as a firm are absolutely open for business to help a lot of the KBIs that are obviously on this line and their clients as well in terms of supporting on that journey.
And in terms of the investment banking expertise that we heard from Quintin, a South African-based family office can get value out of that conversation with Quintin, because they might be a sector, or their business might have been in a certain sector, but they're looking at fintech or they're looking at another space. Is that how you see the value kind of playing out with families who are resident in South Africa, feel like they know the opportunities, but there's still always more to learn? The sector coverage that's not quite there. How do you see it playing out?
So it's the whole journey, and I think probably it's best through an example. So we've had There's a particular family at the moment that are phenomenally successful in South Africa, have built a lot of their wealth in South Africa, but are looking at overseas support with regard to offshore investments, etc., specific strategic investments, both on the continent and abroad. So that's where particularly Effie's team helps them and supports them in that journey through the private banking process. Then what happens is there are a number of sons in this example. One of them is looking to relocate with his family to the UK, mainly to expand their successful South African business to a global platform and establish the headquarters of that in the UK. And so we help them with regard to obviously still on the private bank side through their personal family relocation and what they need. We get into actually conversations on personal banking. I mean, you know, I talk about, okay, your current account and you need to go and shop at Woolly, the equivalent of Woolies in South Africa, Waitrose, etc. in London. How do I pay for it? Where's my credit card? How does it work? So we do, you know, the super nuts stuff around that, the basic stuff. That family is now looking to buy a home, so we provide the relevant credit for them to get their family home in the UK. And on the business side, they're looking at a working capital facility for their particular business. You're then into the world of corporate banking. And we're now into then in the conversation, and this is particularly where Quintin and his team get involved, is where they start looking more and more into actually, I want to raise some financing in the private markets. I want to, I potentially in a number of years want to IPO on the London Stock Exchange. Or I want to strategically acquire another business that is sitting in the UK so that I can grow. So the journey for these types of families is multi-layered. It evolves over time. And for us as a franchise, it's fantastic to be able to help these families throughout their entire journey on a personal level and a professional level. Okay,
interesting. We heard from Effie about, sorry.
May I pop in there? There's a comment. So I think that Amol articulated that really beautifully, but it is exactly the point of my office in the sense that it's really to wrap the whole of Barclays Group around these families that come to us. And all the things that Amol said are absolutely our daily bread and butter. We connect people throughout the whole organization, but equally, we also want to connect clients to each other. So we find people that are in the same sector, for example, but operating similar businesses in different geographies, or that you know, somebody has a technology-enabled version of a more traditional business that is coming through one of our accelerator labs. You know, we have 27 accelerator labs that I mentioned earlier, and hundreds of companies that we've earmarked as innovative, high-growth companies that are in their early stage of development. And a lot of times, people are very interested to meet that footprint, and the footprint is not just it's not just in the UK. We have, you know, US reach. We're in Mumbai. We're in Tel Aviv. You're kind of everywhere where there's a center of innovation. There's some kind of relationship that we have on the ground with these companies, and the range of industries is really vast. I mean, we did a special focus group, for example, in early September on the video gaming and esports sector, which is exploding with growth right now. And people all over the world really fascinated about, you know, how to build the next, you know, killer game. And I mean, it's worth billions, right? If you get that right. So it's just one example of many. So we're really keen to connect people, you know, to more than just, you know, more than just a bank, you know, to things that can be useful to them as they are on their long-term journey of whatever that might be.
Thank you. Amol, just coming back to you, picking up on something that Effie said around increase in demand and appetite and awareness of sustainable investing. I mean, on the ground in Johannesburg in the private bank, how do you see that discussion? In the UK, we've got COP at the moment. You know, we're across the media with the latest trends. What's your sense of clients locally and what their appetites are?
Yeah, look, it's huge. I mean, look, Africa is known as a continent for natural resources. And, you know, it's been across oil and gas, across metals and mining, etc. And it's very interesting. I've covered the continent for over a decade, and it's very interesting how management teams across companies in the investment banking space are pivoting towards realizing more and more, how do we continue to deliver for our shareholders, continue to deliver for consumers but also do that in a sustainable way. I mean, let's be clear, we all own iPhones and they're all made of metal and they all come out of the ground. So it's, yes, you can have a lot of discussion and want to be as environmentally friendly as you can, but people still want their TVs and their iPhones and their X and their Y. So how do we balance all that? It's complex and it's challenging. I think as a firm, across all of our businesses, not just private bank, but across all of our businesses, we have now specialist teams in sustainability, ESG, etc. And we have built a suite across all of our businesses of various types of sustainable products. So, there is a whole buffet menu depending on what your particular taste is and what you like vis-a-vis your particular business. So that's the client side. And I think, as Effie rightly mentioned, I mean, the reason this is also being driven so importantly is the family investor side or the general investor side, because we're now at a situation where, we have some straight conversations with companies and say, you've got growth plans, you want to do X, you want to do Y, but the investor community is expecting X, Y, and Z. And you need to do it, because if you don't do it or don't show that you're moving in that direction, you're going to get left behind. So there are some very, very clear conversations with clients at the moment. And look, it's done in a positive way to help them. This is where we provide our expertise. So, Effie and her team, she's right, and even Quintin, and on the investment banking side, they can tell you what the Hong Kong investor thinks, or the New York investor thinks, or the London investor thinks. And that's what you need to know, because you need to know how to position your company for global capabilities.
Yeah, Quintin, on that note, what's your perspective on sustainability? The companies that you cover, I suppose financial services as a sector, you'd say has fewer problems to solve than some of the other energy intensive industries. But what's your view on the sustainability debate within companies that you cover?
Look, and especially in Africa and the Middle East, Amol mentioned the fact that Africa is natural resources heavy, and so is the Middle East. And the ESG has 3 letters, right? And so whilst in Africa, driving the environmental agenda maybe will take longer, the S, the social opportunity is enormous. And so what fintechs are focusing on these days is to bring the vast majority of the African population that's been excluded from the financial services industry, bring them along. And whilst, today a company that helps finance motorbikes in Africa and make them affordable to or available to on a large scale may not be environmentally friendly today, but what it does in terms of bringing people out of poverty on the S component is spectacular. So I think Africa is on a journey that will take some time to be fully in line on the environmental side versus the more developed markets, but the potential is enormous. And actually, even on the financing of motorbikes, like I mentioned, there's also some environmental solutions with electrical vehicles, and we see more and more of this actually, even in Africa. But clearly, the S component shouldn't be overlooked, I think, and a lot of entrepreneurs are working on this as we speak.
And I mean, do you see interest in things like B Corp status as well? I mean, there's banks in Europe now that are getting B Corp status. Do you think that's something that banks will aspire to in the financial services sector to prove their credentials? We some way off.
Look, I think it is a journey. I think we'll get there, but ultimately there are more pressing needs to be covered in Africa, and the environmental elements will come. They are coming, but the social ones are front of mind in my view.
Thanks a lot.
In some cases, you're able to do 2 birds with 1 stone, so to speak. So there's a fabulous entrepreneurial company in Western Africa called Energicity, which is bringing rural electrification to very impoverished villages there, but it's done through solar panels and through other types of renewable energy. So there's actually an opportunity for Africa in some ways to leapfrog the entire fossil fuel industry and just go directly to renewables. If you're going to be building, infrastructure from scratch, why not future-proof it?
Okay, thank you for that. And a final question here from Lewis Shepherd, just asking about the role of crown dependencies in family office structuring. There's many links between, for example, Jersey, Guernsey, and South Africa. I mean, Amol as well, you see lots of links into the UK between South African families. Jersey is part of and Jersey and Guernsey and crown dependencies are part of the matrix. How do you see that as an offshore centre fitting in, and the UK being as important for your,
look,
your
and
client base?
I'll also play Effie into this as well. But look, yes, of course, it's critically important. I mean, we're representative across all those crown dependencies. It's a significant business. We have many partners who also are obviously set up there. So I think the beauty of the firm, frankly, is we provide offshore and onshore. So we do both, and we've got banking coverage in both. So whether it's Guernsey or Isle of Man kind of depends a bit on the client and what they want and what they need and all that kind of good stuff. But yes, critically important as the franchise, and also important that we have got a couple of hundred people in the Isle of Man. I mean, so it's chunky. So these aren't just satellite places in the middle of nowhere. They're absolutely core to our business.
Effie, what's your view on that question?
No, Amol is exactly right. And also we have a very vibrant fiduciaries business with a lot of families from South Africa, which is it's a very common way to structure your wealth into those jurisdictions. It's as he said, it's a core business. It's been around for a long time. We've just celebrated 100 years in Jersey this past October, so we have earned our stripes there. There's one other jurisdiction that just listening to Johan talking earlier today that maybe didn't come up, but we're seeing really exploding with interest, which is Dubai. And for family offices in particular, there's a massive influx of wealth coming in there and setting up formal family structures in Dubai. And the local legislation is encouraging that. And the families are coming from all over. Of course, Singapore, well-known established jurisdiction as well, and is also accelerating. But for African wealth in particular, I think the proximity of Dubai makes it quite attractive. And of course, UK, we see quite a lot as well.
Interesting. Quick comment from Quintin on that Dubai point. I mean, you're based there, covering clients in Africa and across the region. What's your sense of Dubai at the moment? We met last week, and it was. It seems Dubai is booming.
Yeah, absolutely. And look, Dubai is attracting, whether it's capital or talent. We see more and more people relocating here. And clearly, as the country and more specifically Dubai has reopened earlier than other locations, it's becoming a real hub, both for tourism but also for business and for capital generation. So I couldn't echo more what Effie just said.
Thanks. And Johan, what's your view around crown dependencies and the role, their role in this global picture?
So I mean, South Africa has got a very long-standing relationship, obviously, with the UK, and then also with the UK crown dependencies, and particularly from a financial wealth planning perspective. I mean, countless South African families use either Jersey, Guernsey, or Isle of Man to hold some of their international assets through, and I think that trend will continue. I think those islands are at the forefront of global compliance developments, etc. So I think it will continue to remain very attractive.
Thanks. And your view, Johan, on the sustainability side. I mean, we discussed earlier demand from clients for these different types of strategies. What's your perspective on the ground with clients you deal with? Is the demand there and interest there, or is it still nascent? What's your experience?
I think in South Africa particularly, I think it still is a fairly new concept. I think it definitely has come across so far with a number of families, but I think we've got a long way to go, and we need to place that at the forefront of discussions with families and clients.
Okay, perfect. A good note to end on. Thank you for joining me for this hour, the second part of this series with Barclays. Thank you to Amol for working with us to pull this session together. Contact details of the replay will follow for all of the speakers so that you can get in touch with any particular questions. But otherwise, without further ado, I'd like to wish you a very good day. Thank you.
Thank you, David.